For the better part of a decade, if you brought up Uber, you weren't really talking about a stock. You were talking about chaos.
Oh, completely. It was the soap opera of Silicon Valley.
Right. It was the tech bad boy. I mean, they were burning cash like it was going out of style, fighting regulators in, practically every city on the map.
And that whole philosophy of move fast and break things.
Which, ironically, usually included their own bank account.
It was the absolute poster child for the growth at all costs era. If you were holding Uber stock back then, you needed a pretty strong stomach.
For sure. Nobody knew if the car was going to crash. But today is Wednesday, February 4, 2026, and we're digging into Uber's Q4 2025 earnings.
And it's a completely different story.
It really is. I've had this realization, and it feels almost illegal to say about a tech giant. Uber has become, boring.
And boring is beautiful. In our world, in deep value investing, boring is usually where the magic happens.
Boring is predictable.
Boring is cash flow. Boring means you can actually sleep at night.
And that's our mission for this deep dive. We're going to explore how Uber transformed from this cash-incinerating startup into a profitable, boring utility.
The plumbing of modern transport.
Exactly. We're calling it the era of discipline. We'll unpack this massive $20 billion buyback and then apply a strict Buffett-style valuation lens to see if this stock actually makes sense now.
We're going to strip away the hype, look at the raw numbers. But before we do, I have to give our standard disclaimer.
Go for it.
All this analysis is based on publicly available sources, mainly that Q4 2025 report. These are our opinions for educational purposes. It is not investment advice.
Please, do your own due diligence.
Always. And full deep value research reports are in the description links if you want to check the math.
Also, speaking of doing your own math, if you want to track the total market temperature and see how valuations like this stack up, you should search for and download the Buffett Indicator app. It's on the iOS App Store.
It's an essential tool, really helps cut through the noise.
Okay, let's get into it. The headline for 2025 isn't user growth or flying cars. It's cash.
So much cash. In the life of a tech company, there's this phase they call the valley of death.
Sound ominous.
It is for investors. It's that spot where your costs are massive, you've scaled up, but you haven't actually figured out how to make a profit. Most companies die right there.
And Uber.
Uber didn't just survive it. They built a bridge over it and are now charging a toll to cross.
So put a number on that for me. How much cash are we talking about?
The key stat is free cash flow. For the full year 2025, Uber hit $10 billion.
$10 billion? That's not a rounding error.
It's staggering. I mean, think back to the last decade, from 2009 to 2019. Uber spent exactly $0 on share buybacks.
Because they didn't have the money.
They were burning it. They were paying you to ride in their cars. Now they're generating enough excess cash to buy a small country.
And looking at this Q4 report, the scale of the operation is just nuts. They're averaging 40 million trips a day.
40 million.
That's like the entire population of California taking a ride. Every single day.
That's a great way to visualize it. And the gross bookings, that's all the rides, food, freight, is at a $193 billion annual run rate.
Just shy of $200 billion flowing through the system.
Correct. And they also posted a record GAAP income from operations of $1.8 billion.
I'm glad you mentioned GAAP. For anyone listening, that's generally accepted accounting principles. Why does that matter so much here?
Because for years, Uber relied on adjusted EBITDA, which is a metric that basically says, if we ignore all the expensive stuff like stock compensation and taxes, look how profitable we are.
The ignore the bad stuff metric.
Exactly. It's fuzzy math. But GAAP income, that's real. That's the bottom line after you pay everyone. It means the business actually works. The unit economics are positive.
And it pays. Which brings us to the part of the report that really jumped out at me. The buyback. $20 billion.
It's a buyback bombshell. This is huge.
Okay, but let me play devil's advocate. When a tech company does a huge buyback, doesn't that just mean they've run out of ideas? Like, we can't grow anymore, so here's some money back.
That is the cynical view, and sometimes it's true. But here, it signals two very positive things. First, confidence. Management is saying, we think our stock is undervalued. Buying it back is the best investment we can make.
They're betting on themselves.
Heavily. And second, it signals that shift in philosophy, the era of discipline. They aren't hoarding cash for some crazy expansion anymore. They are returning value to shareholders. It is the ultimate sign of a maturing company.
So the rebellious teenager finally got a steady job and started maxing out his 401k.
That's a perfect analogy. They've graduated.
Okay, so we have the cash, we have the discipline, but I want to understand the engine. From a business mechanics perspective, why is this model printing money now?
It comes down to a concept called aggregation theory.
Break that down for us.
Aggregation theory says the winner isn't who owns the supply, like taxis, but who owns the demand, the customers. Uber wins because it controls the customer relationship.
It's that flywheel effect, right?
Exactly. More riders attract more drivers. More drivers mean lower wait times.
Which in turn attracts more riders. No one wants to wait 20 minutes in the ring.
Precisely. It's a self-reinforcing cycle. And that creates a moat. Now, analysts call it a narrow but solid moat.
Narrow seems weird for a global company. Why narrow?
Because it's a localized network effect. 10,000 drivers in New York City does nothing for you if you're trying to get a ride in London. You have to win city by city.
Why?
But because they have won that density almost everywhere, it's very hard for a new competitor to break in.
Because if I want to launch Dave's rideshare, I had to spend billions just to get pickup times down to 3 minutes.
Exactly. You'd burn all your capital just getting to the starting line. It's a massive barrier to entry.
That makes sense. But here's where it gets really interesting for me in this Q4 report. It's Uber One.
The membership program. This is their secret weapon.
The numbers are insane. 46 million members, up 55%. But here's the kicker. 50% of their total gross bookings now come from those members.
That is the statistic that changes the entire valuation model.
How so? Why does Wall Street care if the money comes from a member? A dollar is a dollar.
Not in valuation. Memberships turn a transactional business into a subscription business. Before, every ride was a battle. You had to hope they opened your app, not Lyft's, but an Uber One member. They've already paid the fee. They're psychologically locked in. It's the Amazon Prime effect. You paid for it, so you use it for everything.
So it lowers your customer acquisition cost, the CAC.
Massively. You aren't constantly rebuying your own users.
Yeah.
It turns a luxury, I'll take an Uber, into a utility. I'll just Uber it.
It becomes infrastructure. And looking at the revenue breakdown, mobility is 57%, delivery is 31%. But there's a sleeper hit in there, advertising.
Yes. It's only 1% of revenue now, but don't sleep on this. It is extremely high margin.
Because the app is already built.
Right. They have a captive audience staring at the map. Selling that attention costs Uber almost nothing. It's pure profit.
Okay, so it sounds perfect. A cash machine, a solid moat, a subscription model. Which means you're about to tell me why this might all implode.
There are always risks. And for Uber, there are some bumps in the road and maybe a cliff off to the side.
Let's start with the bumps. What's hurting them right now?
The immediate headwinds are all macro, inflation. If disposable income shrinks, people cut back on delivery first. They take the bus.
It's discretionary spending.
Exactly. And the other thing is the strong dollar. 60% of their bookings are international. So when they convert those euros or yen back to dollars for their reports, the number looks smaller.
So it hurts the headline number, even if the business is fine on the ground.
All right.
Okay. Those are manageable bumps. What's the cliff? What's the existential threat?
It's the robot in the room. Autonomous vehicles.
The robotaxi. This story never goes away.
Because it's the biggest question mark. The dire case is that a Tesla or Waymo launches a massive fleet of robotaxis. And because there's no driver to pay, they can price rides incredibly low.
Right. If I don't pay Steve, the ride should be cheaper.
They could undercut Uber by 50%. And just like that, Uber's network of human drivers becomes obsolete overnight.
That's a valid fear. If I can get a ride for $5 from a robot or 10 from a human, I'm taking the robot.
Most people would, but Uber has a defense strategy. They're pivoting to become the operating system for AVs.
So instead of fighting them, they manage them.
Exactly. Their pitch to Waymo is, you have great tech, but you don't have demand. You don't have 200 million people opening your app. Put your cars on our network, and we will fill them instantly.
Is there data to back that up?
There is. The report noted that AV trips on Uber's platform are 30% more utilized than standalone AV competitors. That's a massive efficiency gain for fleet owners.
So they want to be the Amazon marketplace and the AV companies are just merchants?
That's the goal. But it's a delicate dance. It's the ultimate frenemy situation.
And briefly, the regulator issue. That never really goes away, does it?
No. The driver classification employee versus contractor is a permanent risk. If a major market forces them to classify drivers as employees, costs would skyrocket and break the whole model.
Okay, so we understand the business, the risks. Let's get to the valuation, the Buffett-style breakdown.
Right. This is where the rubber meets the road. It's easy to say a company is great. It's harder to say the stock is a good buy.
And just a reminder, if you want to apply these kinds of metrics yourself, don't forget that Buffett Indicator app. It's great for seeing the big picture.
Okay, so the deep value lens on Uber. We look for 4 things: cash flow, safety, efficiency, and price.
Let's start with what passes the test.
First, cash flow. We want a free cash flow margin over 5%. Uber is at 20.2%. That's an easy pass.
Nice. What about safety? Are they drowning in debt?
We look at debt to equity. We want it under 0.5. Uber is at 0.37. Very safe. Another pass. Yeah.
And efficiency.
We look at return on equity, ROE. Uber's is over 70%. Now, that's a bit inflated by some tax assets, but even adjusted, it's very high. So efficiency is a pass.
Okay, 3 for 3. This sounds like a slam dunk, but I'm guessing price is where we hit a snag.
That's usually the catch with tech. We look at price to book. A classic value investor wants to pay less than 1.5 times book value. Uber is trading at 5.9 times.
Ouch. That's steep. But you're paying for the intangibles, right?
Yeah.
The brand, the network.
You are. But a strict value investor walks away right there. It fails that test. You're paying a premium.
So what about the margin of safety? What's the stock actually worth?
This is the big one. We ran the discounted cash flow models. The stock's trading around $80.84. Our model puts fair value at around $95.
So it is undervalued.
It is, but only by about 16%. A deep value investor wants 25% or more. They want to buy $1 for 50 cents. This is more like buying $1 for 84 cents. It's a deal, but not a steal.
So it's not a bargain bin special.
No, it's what you'd call quality at a fair price.
Let's talk about those scenarios. Fair value depends on growth, right?
Correct. So in a no-growth scenario, if they just keep making $10 billion a year forever, the stock is worth about $67.
And it's at 80. So the market is pricing in some growth.
It is. Then there's the nominal growth scenario, say 15%, what management is guiding towards. In that case, the stock is worth about $116.
Okay, so if you believe management, it's significantly undervalued.
Exactly. And then the bullish case, they dominate AVs, advertising takes off. That pushes the value up to $181.
So why is the market hesitating?
Because it's cautious. It's pricing Uber somewhere between no growth and nominal. Investors are still skeptical about the AV threat and regulatory risk. It's a quality compounder, not a get-rich-quick stock.
A mature investment for a mature company. It really has come a long way.
It's graduated. It's a real business now.
So, to synthesize this, Uber is no longer a speculative tech bet. It's foundational infrastructure. In many cities, it's basically too big to fail.
That's the conclusion. You get utility-like reliable cash flow with a call option on the future of autonomous transport.
Before we wrap, I want to leave you with one last thought. Uber has 202 million monthly users. They own the demand.
They own the screen you're looking at.
So if Uber owns the customer, does it actually matter who owns the car? When you call an Uber, you don't care if it's a Toyota or a Waymo. You just want to get from A to B.
That is the critical question.
Uber might just be the toll booth for the future of transportation. And the guy running the toll booth always gets paid.
It's a powerful position. Being the aggregator is usually better than being the supplier.
Something to think about next time you're in the back of a rideshare.
Indeed.
All right, that's a wrap on our deep dive. If you want to run these numbers yourself, don't forget to search and download the iOS app Buffett Indicator from the Apple App Store. It's a fantastic resource.
And remember, if you want to listen to our full deep dive on this or get more advanced content, you're welcome to join the Deep Value Club membership or subscribe to us on deepvalues.ai.
Don't forget to like this video. Much appreciated. Thanks for listening, and we'll catch you on the next deep dive.
Stay curious.